So today we're going to talk about some accounting and auditing updates for accounting standards that are either in place already or will be coming up within the next year or so. Again, these are already in place or they will be coming in place. We're going to be talking about in-kind contributions, leases, audit report changes, and current expected credit losses. And some of these we've covered in years past. So there were going to be a very high level coverage of those, but they are effective. They will apply to most of you in the room. So, it is going to be imperative that you pay attention to these and you implement them as needed according to your organization. So I'm Gary Snyder. I'm an audit manager in the Chambersburg office. I've been doing this for 25 years, and I serve various nonprofit organizations and other organizations throughout the year. So our first topic is in-kind contributions. This standard was issued in September 2020. It was 2020-07 presentation and disclosures by not-for-profit entities for contributed non-financial assets. Current GAAP really only includes specific requirements for contributed services, but they do not address recognition and disclosure requirements for non-financial assets that are contributed to an organization. So this standard is designed to basically put a framework together for what is required to be included and disclosed for those non-financial assets. The basic premise of this is to provide transparency from when you're comparing organization to organization by breaking out the contributions on your statement of activities to show financial contributions and non-financial contributions. I have a couple examples of these also. But it's also designed to provide information about how you use those non-financial assets. Did you use them in your organization, or did you use those for specific purposes within your programs, and how you utilize those contributions you did receive? Again, we are presenting the non-financial assets as a separate line in the statement of activities, and we are putting more description into the non-financial assets and how we did utilize those assets as they were contributed. So some of the requirements are qualitative information about whether the donations were monetized or utilized. So if you have a policy that you monetize, you receive a contribution of a vehicle, and your policy is we're going to sell it, we're going to get the cash. That needs to be disclosed in your financial statements. If you have specific policies that if you get certain food items, then they're utilized for a specific program. Again, that needs to be included in your disclosure. So there's a lot of qualitative information explaining what you're doing with these assets as you do receive them. You do need to disclose any donor-imposed restrictions that you do have on those assets. If there is some kind of donor restriction, you do need to disclose that also. And then the market you use to determine the fair value for those assets. And again, those markets can vary depending on what type of asset you received, but you need to disclose that market that you did use for that asset. So here's a couple examples. These are right from the standard. This is very simple, but the statement of activities just goes from a single line of contributions that is now gone. It is now contributions of cash and other financial assets, and then contributions of non-financial assets. So it's very simple, just to breaking that contribution line into two more specific lines. Here's an example of non-financial contributed assets quantitatively, and then there's qualitative information also. Then you can see in this example, they got a building, they got housing goods. It basically shows what assets they received and the dollar value assigned to those assets. Along with that, though, then you're going to have to put some qualitative information to disclose, okay, what did you do with those assets? How did you use those assets? So in the first paragraph in my examples here, they did receive non-contributed financial assets, including contributed building, vehicle, etc. Unless otherwise noted, those non-financial assets did not have any donor-imposed restrictions. So if there are donor-imposed restrictions, you need to disclose what those restrictions are and which assets are restricted. The second paragraph is their policy for monetizing vehicles. Their policy is to sell all vehicles, and then they take the cash proceeds from those vehicles and they utilize those for the organization. Then the third paragraph, the contributed building, they did get a contributed building. They did use that for their operations. And then they also are disclosing how they determined the value. So the value was based on the market value of the comparable sales within their market value area that they use for other buildings. Contributed food, they also got contributed food, and they had to use that for various programs. And again, they're disclosing at the bottom there that they use wholesale values received for similar products within the United States to value those goods that were received. This one's a unique example. Number one, it is restricted. So they got contributed pharmaceuticals that were restricted by the donor to use outside the United States. So that's a very specific restriction. But what makes this unique then is some of these can be valued in the United States because they are legal, but some of these are not legal drugs within the United States. So they have to go to an outside market where these are legal to determine that value. So again, there's two different methods here used to value those, and you need to be very clear on that disclosure of how you arrived at those values you're using to disclose those. This is the same information. It is just more of a tabular format. Again, you're describing what the asset was you received, the dollar value you recognized, how it was utilized, whether it was used for programs or whether it was used for the operations themselves, whether there were any donor restrictions, and then again, the method used to value those assets. So those were very simple examples. It's really not that significant. Some people have been doing this in the past anyway, but this standard really formalizes it and says this is what we need to include, this is how we need to include it in the information that needs to be disclosed. So this was effective for periods beginning after June 15th, 2021, so it is effective now. So if you do have any non-financial contributed assets, you do need to be accounting for these and disclosing these now. So the next topic is leases. I know leases is one of those that's been around seems like it's been around for years, and they just keep kicking the can. Well, it's here. So this is one we have to implement. We need to, if leases impact you, now is the time it is effective this year, so it needs to be implemented now. So the whole purpose of the lease standard 2016-02 was to increase transparency among organizations. So, some organizations they paid leases, they paid monthly lease payments. They went through the income statement. You had no idea what the obligation of all those leases were. You could have some organizations that have hundreds of leases with obligations related to those that never would show up in the financial statements. So under this standard now, it's requiring you put an asset and a liability on the balance sheet so you can compare one entity to another entity and determine what those lease liabilities related under the underlying leases of those. The liabilities related to that is on the financial statement so you can compare entity to entity. It does require recognition of lease assets and liabilities even for operating leases, which is different from current GAAP. The lessee accounting has significantly changed. The lessor it really did not have any impact on, but this does only apply to the leasing of property, plant, and equipment. So finance versus operating leases. So finance leases, this is very similar to what current GAAP is. Finance leases I equate to current capital leases. There are different definitions here, but they're very similar to what the capital lease criteria is now. If it is a finance lease, the lease transfers ownership of the underlying asset. The lease grants the lessee the option to purchase the underlying asset. The lease term is for a major part of the remaining economic life. And again, that used to be a specific percentage in the current GAAP under the capital lease criteria. Present value of the lease payments and the residual value guaranteed substantially exceed all. That, again, was a percentage in the capital requirements. And the underlying assets is of a specialized nature that is expected to have no alternative use. So if it falls into any of those categories, it's going to be considered a finance lease. Operating lease, on the other hand, then is very simple. If it's not a finance lease, it's an operating lease. So, okay, you say, what's the difference between finance and operating lease? What does that mean for accounting for them? The initial recording of the asset and the liability for both of these is exactly the same. You're going to record a right of use asset. You're going to record a lease payment liability on the balance sheet for both of them. The difference is in subsequent periods then. You're going to, under the finance lease, you're going to recognize interest on the lease liability separate from the amortization of the ROU. So you're going to have interest and you're going to have an amortization of the ROU. On the cash flow statement, then, you're going to have principal payments are going to be classified as financing, but then your interest payments are going to be considered operating in your statement of cash flows. On the other side, operating leases, you're going to recognize a single lease cost over the term of the lease, which is generally a straight line. That's going to be amortized off. And then all those payments are going to be considered operating. That's really not different than what we're currently doing, other than you're going to amortize off that asset that you recorded. So this does introduce a concept of ROU asset. It is an intangible asset. It's a long-term asset. It gives you the right to use that asset. It's typically classified as long-term, and again, it is amortized over the term of the lease. The LPL is probably the most critical piece and probably the most one that's given everybody heartburn. It does require you to make sure right out of the gate that you are recording all of the liabilities you have under this lease agreement. And there could be many components to that. You have a fixed lease payments, you could have variable lease payments, you could have exercise options. You can have various options that allow you, you can go for 10 years and then there'll be an option for another 2 5-year terms or something like that. So at the onset, when you're recording this, you're going to have to determine what is the likelihood that I'm going to exercise those options, and that needs to factor into your calculation. So the upfront, getting this recorded correctly is the most critical. Once you get it recorded, the mechanics of recording after that's pretty simple. But it is critical to include all of these components. Anything that you know of that is going to be included in that liability needs to be included upfront. So this is based on a discounted present value calculation that obviously is based on a rate. That's usually the rate that's implicit in the lease. However, most leases do not have a rate implicit in them. So if you have borrowings, you can use your current incremental borrowing rate you would use for other borrowings. If you do not have borrowings, it does allow you to use a risk-free rate or a Fed funds rate. However, you need to be careful that you don't have a whole lot of options, but you need to be aware that asset and liability are going to be higher than, because you are using a much lower rate than your typical borrowing rate you would use. Lease disclosure, this, again, with the standard, it does require a lot of disclosures. I'm not going to go through these, but in general, you need to describe the terms of the leases, any subleases you have, any options you have. There's a lot of descriptions that need to be included within this standard that was not required before. So you just need to make sure you're fully disclosing and describing the lease terms of these leases as you're recording them. Quantitative information is exactly the same. There's a lot more information that is required to be disclosed. There's a listing here on my slide. The key piece here is at the bottom, additional info, all the above information has to be disclosed separately for finance versus operating. So if you have financing leases and you have operating leases, you can't combine them together and disclose them in one total. You have to disclose operating leases, all this information, and financing leases separately. So that is a requirement to be disclosed separately. So I do have a couple simple examples here. We do have a 3-year term lease. This is an operating lease. Requires payments of $100 a month for 36 months. The present value is calculated to be $3,000. So at the inception, when you record this lease, you're going to record your right of use asset and your liability for the $3,000. It's very simple. Then in subsequent years, you are going to have 1 year of payments, 12 payments at $100, is $1,200. And then the present value of the lease payments at the end of year 1 is calculated to be $2,000. So your entries to record the lease expense, or the payments you're making for the leases, is $1,200 for lease expense and $1,200 for cash, which is no different than what you're doing now currently under a lease, operating leases. The difference now is you're going to reduce that liability and that right of use asset by $1,000 to get it down to that $2,000 value at the end of year 1. Finance lease example, we have a 5-year office space lease, $1,000 a month for 60 months. The present value is $55,000. So again, it's exactly the same when we're recording it. We're going to record the right of use asset and the lease payment liability for $55,000 to get it on the books. And then in subsequent years, you're going to have 1 year of payments, 12 payments of $1,000 or $12,000. And the present value of your lease payments at the end of year 1 is calculated to be $45,000. So you're going to have $11,000 of amortization expense, and the right of use asset is going to be credited for $11,000 to write down that right of use asset over the 5-year term. So it'll be the $55,000 divided by 5 would be $11,000 a year. And then your lease payment, when you make that payment of $12,000, part of that is going to reduce the liability, and part of that is going to go to interest expense. Again, this is very similar to what we're doing currently under the capital leases. So when this first came out and people started implementing a standard, there was a lot of pushback. As you can imagine, some organizations have hundreds and hundreds of leases. To try to go through all your leases and determine, are they financing? Are they operating? How should they be recorded? What options do we have? There was a lot of work and a lot of pushback. So the standard setters basically said, look, we've got to come up with a better way to get this on the books. So they came out with some practical expedients, and I'm not going to go through these, but basically it allows you to use hindsight and go back and evaluate things much simpler just to get them on the books. The whole purpose of this concept is to just get an asset and liability on the books and move forward with it. So again, there are some practical expedients that are available to you. There was another ASU issued in 2018 that does allow you to basically implement it as if whatever it is on the date when you implement lease standard, if you have an operating lease, it stays an operating lease. You don't have to go back and determine, is it a finance lease, is it an operating lease. So in essence, this is highlighted at the bottom of the slide, it basically allows you to record these in the same manner you currently do. The only difference is you're going to have an asset and a liability going forward. So whatever it is, when you implement this, you're going to record the asset liability, and you're going to record those entries going forward, but you don't have to determine as an operator, as a finance, until you reevaluate that lease. It gets renegotiated, you get a new lease, whatever. Then you have to reevaluate it at that time and say, is it financing, is it operating, and adjust accordingly. But otherwise, you can just keep going with what you have. So again, it just makes it a whole lot simpler just to get the assets and liabilities on the books and get it recorded under the standard. And that is effective for 2022. So that is effective now. So if you have not implemented the lease standard, or you've not thought about it, and you have leases, you want to get on this as soon as possible, because there is a lot of work behind this calculation, is just getting it on. Again, a lot of the work is up front. Once you get it on, then the mechanics of it going forward is not that complicated. Next topic is audit report changes. I'm going to go through this rather quickly, but based on our previous survey, it seems like there's a majority of you that have audits. So I'm just going to kind of highlight some changes that were implemented in 2019 as part of a suite of other changes. The audit report did change after many years of not having any changes. So the audit opinion is now on the front. It does have more titles. It does introduce the key concept of key audit matters, which we'll just talk about. And it does require additional disclosures about auditors' responsibilities as well as management's. So the audit opinion is now the first paragraph of the report instead of the last. So, let's face it, when you get the audit report, you're looking for the opinions. They just cut the chase. So we're going to put that to first paragraph. So the audit opinion is now the first paragraph. Right below that, there is a basis for opinion paragraph now. That was only included for modified opinions before. Now it is included for any opinion. So there is an audit opinion, then the basis for opinion is right below that. There's also additional information about the auditor, that he has followed gas. Separate sections describes auditor's responsibility. There's a separate section about auditor independence now and the requirements under that, and whether the auditor believes audit information is sufficient. Key audit matters is new. That was added if the auditor was engaged to issue communication on these. So unless we are engaged, we are not going to be issuing this in the audit report, but if we are engaged to issue that, it does need to be part of the auditor's report. It is basically for areas of higher risk, significant concentrations, valuations, material misstatements, like something like that. Anything that has judgment, that would need to be included in those key audit matters. Again, management's responsibility is expanded. There's now bullet points for our responsibilities within the report. I just did a report yesterday. It went from page to basically 3 pages now. So it's much more expanded. It's going to be at least 2 pages. In some cases, depending on the paragraphs we have to add, it could be 3 pages just for the auditor's report now. So this was effective for periods after December 15th, 2021. So if you were a 12/31/21 year-end audit, you've already got your audit report. It should have been it. June 30th is coming up. Your audit report is going to be changing for this. Last topic is current expected credit losses. We touched on this last year in this conference. This was a result of the economic crisis back in 2008. It came from the banking crisis primarily. And under current GAAP, it is under it's incurred loss model instead of an expected loss model. So this is changing GAAP to one from what you are currently incurred to what you expect to incur based on losses within your receivables portfolio. It's designed to make you recognize those losses more quickly within the financial statements, and but it is very broad in how you get to that end result. Let's put it that way. So it does require you to do some kind of probable forecasting. How you came up with that, how you came up with information of how what you feel the future is going to look like, which is a new concept to current GAAP. But you're still going to use historical information, current information, and then again, a reasonable and supportable forecast, including prepayment estimates within that calculation. As I said, this is very broad. The methodology does not spell out a lot of specifics. That's very broad. It is very scalable. So it is designed for the smallest organization with the simplest receivables to the largest organization with the most complex receivables. And you basically, it's up to your judgment to scale this thing to meet your requirements. It is based on judgment, which makes us as auditors pause because that's even more judgment. And again, the key piece of this is going to be documenting how you got to your end result. What did you use? What kind of historical data did you use? What kind of qualitative data did you use? And then the forecasting piece is going to be critical. How did you get to that? How did you get to your rationalization of what you are using within that calculation? So again, the loss history is the starting point. You're going to start with your loss history just like we always have. You're going to put in some qualitative factors of here's what our economy looks like now. Here's what our trends have been. That's not any different than what you're doing now. The biggest piece is going to be adding on the forecasting. The nature of the receivables and the method you determine that is going to, again, be based on your receivables. If your receivables, this is going to impact you. But if you have a very simple receivables portfolio, it's not going to have as big of an impact as if you have a complex, large receivables portfolio. The biggest piece that's going to give everybody headaches is the forecasting piece. Again, current GAAP does not look forward. Basically, it's based on historical data. So this is a new concept for everybody. And I'm already hearing, okay, where are we going to get this information? We expect there's going to be shops that are going to be opening up, and we'll give you information for your fee. Here's what we think our forecasting is going to look like. That can be okay. However, you need to make sure that forecasting they're providing you makes sense for your organization, because it may or may not make sense. But this is going to be the biggest challenge for everybody to get that information. However, the Federal Reserve does have data. There are trade organizations that have some data. You can go based on past trends, and then you basically come up with, okay, based on past trends, based on current events, based on what events we think are going to be happening forward, here's a factor that we're going to put in for the future that we feel will affect our portfolio at this point in time to recognize a potential loss. You're basically recognizing potential losses on your receivables day one. When you book a receivable, you're putting a factor against that receivable, what you think you're not going to collect of those receivables. It's tricky, and it's not going to be easy. One thing that they come up with, what happens when you go through all this and you still have zero losses projected? That can happen, and that's okay. But the key piece there is it is truly documented. You are documenting that thought process, how you got to that, and you can't just say, okay, I've got zero losses, I don't have to do anything. It's got to be a continual evaluation of that to verify and document that you don't have any losses within that portfolio. Because we're not going to be able just to come in and say, well, they don't have much, we're okay. We're going to have to see documentation to verify that you went through the process and you determined that there were no losses within the portfolio. And again, this applies to any receivables. There's a big misnomer out there. This came from the banking world back in 2008 when the banking crash from the housing bubble. But there's a big misnomer that this only applies to the banks. Yes, the banks are going to have to implement this, and it's going to significantly impact this. But it is across the board. It's going to affect anybody that has any kind of receivables, whether small, large, it is going to impact you. So, if you're in that boat that's saying, this isn't going to impact me, if you have receivables, it is going to impact you in some way. That was effective in 2023, which is next year. And you'll say, that's next year. We've got plenty of time. A lot of the banks, again, the banks are more complicated. They are running theirs parallel now to what they are doing, just to make sure and doing any tweaks they need with that calculation now. I would strongly encourage you, if you have any sizable receivables portfolio, to start looking at this and evaluating this now. You do not want to wait to the beginning of 2023 to start implementing this. So key takeaways, the contributed non-financial assets and lease standards are effective this year, and they will impact you if they do apply to you. So make sure you are looking at that. CECL is coming up and will impact you again. If you have any kind of receivables, it will impact you. So take the time now to analyze this information and make sure you're ready when they are effective for you.